What's up, good people? My name's AJ, and today I'm talking about passive versus active investing. The passive versus active debate is a pretty big one in the investing or finance community today. And if you're unfamiliar, basically the difference is passive investing involves buying indexed funds, which are extremely cheap funds. They have low expense ratios. Some are 0% now. And they are just stated to stick to whatever a certain benchmark invests in. So there's no one making investment decisions on your behalf. You're not trying to outperform the market. You're just paying low expenses to get the average return of whichever benchmark you choose. Active investing is kind of the opposite of that. It's higher expense ratios. Those fees are going to cover the salaries and related expenses for active managers who are doing work on the back end, researching different stocks or bonds, and making investment decisions in the hopes of outperforming whichever benchmarks those funds are tracking. So passive is cheap and easy, active is more expensive, and there's people doing work on your behalf to make investment decisions. So I'm going to answer this question from two perspectives. One is the average investor or 401k plan participant, which likely would be you. And then the other would be more of an institutional money manager. If you follow this trend at all for the last 8, 10, 12 years, you would know that there's a huge push towards passive investing, and much more of the flows of new money have been going into passive investment vehicles, which would include ETFs or indexed mutual funds. Now, various internet forums, Reddit I think is the big one, are huge advocates for passive investing for most people. When people get on there and ask for their own financial advice and you have Reddit gurus on there giving it out, most of the time they say buy passive funds. Actually, there's a really big bias towards Vanguard indexed funds, which I don't totally understand. Vanguard, in a lot of cases, isn't actually the cheapest passive investment fund offerer. But nonetheless, there's a push for new investors to get into passive investment vehicles. Warren Buffett, one of the best investors of all time. A lot of people call him the greatest of all time. I wouldn't say that, but Warren Buffett also contends that regular individual investors should be buying passive investment vehicles. They're very low cost. You can just buy an index like the S&P 500. And he's gone out on a limb to say that even hedge fund managers, which are sometimes considered the best experts in investing and also charge the highest fees, he's gone out on a limb to say that hedge fund investors cannot outperform a S&P 500 index. And over the last 10 years, he's definitely been right about that. So even he, who is sometimes considered one of the best active investment managers of all time, encourages folks to invest passive. So when I think about this trend, basically, from what I've seen, there's one primary study that is the largest and most comprehensive study on the debate between these two topics. Now, it was funded by Vanguard, so keep in mind that Vanguard has a bias in this debate because they are the largest issuer of passive investments and they make billions and billions of dollars a year off of people putting their money into passive investments. But you can still look at the study, draw your own conclusions based on the information they present with the understanding that they advocate for passive investments. So basically the results of the study, and I share this with a lot of my clients, are that 91% of mutual funds, which is active investment managers, over I think it looked at a 10-year period, net of their expenses, so their net performance, so say they made 10% and they charged a 1% expense ratio, that's the 9% number that Vanguard's looking at. Net of their expenses, they're not worth holding. 91% of active mutual fund managers underperformed their benchmarks over the last 3, 5, or 10 years. That's pretty bad. So when I talk about this with my own clients, they say, 91% of these people aren't doing their job, or whichever industry they're coming from. Typically, in investing, you'll have good years and bad years. Other industries are get your work done, get it done, get it done. And so when they see something and in their mind they're equating those managers to not getting their job done, meaning beating that benchmark, they're like, why do these people still have jobs? And sometimes you can ask yourself that same question. It's a fair question in some instances. So just looking at that, with 91% of investors, active managers underperforming the benchmarks, right away you think, okay, passive's the better option. Now Fidelity made an adjustment to that study and used the same data set, and in the opposite light, Fidelity is one of the biggest active managers, so of course they're going to have a bias to want people to invest actively. So again, take their adjustments to that study for what they're worth, make your own decisions, but also know that that's kind of the side of the table that Fidelity sits on. And what they did was showed that if you exclude the higher 50% of expense ratios, so basically get rid of the really expensive half of active managers, and that leaves you with the cheaper half of active managers, and then also exclude active managers from minor fund companies. So small boutique firms in, I don't know, Atlanta or Charlotte, North Carolina, or whatever, that have mutual fund offerings out there. Also exclude the small boutique firms. I think Fidelity might do that to say, a larger firm has more research expertise to be able to make active investment decisions, which Fidelity is the largest mutual fund manager, or one of the top 3, I should say. I think American funds might be up there. But when you make those 2 adjustments, I think their number was about 55% of active managers now were underperforming their benchmark. That's a lot lower number than 91% underperforming their benchmark. So it's 2 simple adjustments, and you're about half of the remaining pool of active managers are gonna beat their benchmarks in any given year. So then I take that information, and in our firm, we use about half and half active, half passive, and we use Fidelity's information there, do a little more narrowing down of the pool of remaining mutual funds, and look at other things like risk-return characteristics or tenure of the fund managers and other things that we think can be important or predictive of potential future outperformance. And then I think you can really get narrowed down. When you have someone that has some experience in mutual fund selection or investment selection, you have a much better chance of finding active managers that are actually going to be beating their benchmarks. And so while I think passive makes sense for most people and people managing their own funds in their own 401k, passive is always an easier option. Doing the right screening of active managers can result in giving you a smaller pool of active managers that will actually outperform their benchmarks and do better than what a passive investment vehicle could do. I don't think everyone should be looking for their own active outperformance, so I don't think people should be picking their own stocks, let alone their own active mutual funds, because it takes, I don't even try to pick my own stocks, and I'm a CFA charter holder. Picking a stock involves so much more work that I'm not even going to talk about in this video, and being right about that, I should say. Picking a mutual fund also requires just some experience in what types of things can allow a mutual fund manager to consistently outperform. So again, for most people, a lot of times it makes sense to just be using easier passive investment options. So 2 other quick studies I kind of want to point out here. One is a major argument that you hear from people towards passive investing, and that's that, well, if you pay 1% per year in an expense ratio to a mutual fund, and then you compound that over like a 40-year savings horizon, then at the end of that period, you will have cost yourself, $250,000 or $500,000 or $1 million in fees to those mutual funds, rather than just looking at the passive investment vehicles expense ratio, which is 0.03 or 0.05%, or just 0% in some cases. That argument is not a totally fair argument. They're totally ignoring the fact that those active managers will sometimes outperform those benchmarks that they're charging the fees for. So the much more important metric to look at is the net return or net performance of the funds, net performance of the passive fund versus the net performance of the active fund, which means after that expense ratio. You cannot just simply look to the expense ratio and say, well, if you add up this expense ratio over 40 years, it's going to be a big number relative to the passive expense ratio, which is tiny. Of course, that's going to be the case. One number is bigger than the other. And then they just compound it. And then they show these numbers on graphs and say, active investing is evil. You should, I think, one of the late night shows, Jimmy Fallon or Colbert or something, or actually maybe it was the guy that does comedy with the British accent. One of those like late night TV shows picked up one of those studies and said, look how much you'll pay in fees if you use an active fund over 40 years. And they just looked at fees. They didn't look at net performance. They didn't look at the fact that if you do a little bit of due diligence, sometimes those active mutual fund managers will actually outperform their benchmarks. Yeah, you paid some fees, but your net return was still higher. So that study that just focuses on fees that are being paid and compares active to passive does not compare net performance, and so it's not a fair study. I think it's one that a lot of people look to. So when you're looking at things like this, just understand that the publishers of those studies probably have some type of bias or agenda that they're pushing, and again, take that information, make your own conclusions with the understanding of who's publishing. And the other main trend that you'll see is that the relative outperformance of one of those two sides, either passive or active, differs based on the time period that you're in. So you'll see 10-year periods of time in the last 100 years where passive outperforms, and then 10-year periods of time where active outperforms, and it's kind of a pendulum going from active to passive outperformance. So while the last 10 or 12 years in the current market cycle, passive has totally outperformed active across the board, it's largely been due to the top 5 stocks in the indexes, which are like Apple, Amazon, and Google, also being some of the best performers. It's a really unique period of time we're in where the largest names are also the best performers. And so in an environment like that, active is almost really probably never going to beat passive. There's just no way that the active managers, unless you were just someone who, instead of holding the index, your active strategy was just to hold the 5 highest weights of that index. Fortunately, that strategy would have worked out for you over the last 10 years. There's, of course, no guaranteeing that that trend is going to continue for the next 10 or 20 or 30, 40, 50 years into the future. So the fact that passive has been extremely outperforming active investing over the last 10 years, I don't think someone should draw a conclusion simply based on that. There are really good studies and charts out there that'll show you that active will sometimes come into favor and passive will sometimes come into favor relative to the other option there. So there are several considerations in that debate. Again, I don't like when people kind of take an agenda or push their own agenda, I should say, and just tell you that one is definitely right or one is definitely wrong, because the answers both work in their own right. And if they're both leveraged correctly in your personal financial planning, then they can both be really good tools. So I'm not going to make any comments about which is definitely better, but I kind of shared my point and my firm's take on which ones we use with our own clients. So take that information, let me know your thoughts in the comments if you have any feedback for me, and thanks for watching.